I'd like to go ahead and introduce our host, Sonya Sheth, Fixed Income Marketing Manager for Freddie Mac Single-Family. Sonya has been in the financial industry for 15 years, joining Freddie Mac in 2013 as a Senior Portfolio Manager on STACR. In 2018, Sonya built the Fixed Income Marketing team to provide support to Freddie Mac's growing CRT programs. Sonya holds an MBA from the Robert H. Smith School of Business, University of Maryland, and a bachelor's in economics from the University of Maryland, College Park. So with that, I'll turn the call over to Sonya. Sonya.
Thank you, Baha, and good afternoon, everyone. I have the pleasure of introducing our presenter for today, Mike Reynolds, Vice President of Single-Family Credit Risk Transfer at Freddie Mac. Mike has contributed to the U.S. housing industry for over 25 years, joining Freddie Mac in 2012 to launch the first of its kind STACR securitization program, which established the GSE CRT market. In 2019, Mike's role expanded to include oversight of Freddie Mac's ACIS reinsurance platform, as well as front-end mortgage insurance programs. Mike holds a master's in finance from George Washington University and a bachelor's in business administration from Northeastern University. With that, welcome, Mike.
Thank you, Sonya.
Sure. Now, before we get into the meat of it, I'd like to start off this afternoon's discussion with a poll question for our audience. What is your biggest concern in 2020 with respect to your participation in CRT? Is it A, economic downturn, B, interest rates, C, performance, D, liquidity, E, spreads, or F, other? Go ahead and make your selections now, and we'll reveal the responses in about 10 seconds. Thanks for the responses. It looks like the biggest concern that majority of the folks on the call have is E, spreads.
That's interesting, probably not very surprising given the audience. And we'll certainly talk about spreads. The second one on that list was economic downturn. So we'll try to touch on both of those. The way we have it set up is we're going to do a recap of the housing market. We'll talk a little bit broadly about CRT, dig into the performance of CRT, delinquencies lost, then do a look forward for what we expect in 2020. We're hoping to have some time for questions, and as Baha said, please send some questions in, and we'll try to answer questions that seem most relevant for folks that have joined. We really appreciate you taking the time out of your day to come on the webcast. I know it's not as good as a face-to-face meeting, but we did want to try to get something on your calendar, early in the year before some of our conferences, just to broadly get the message out of some of the key themes that we're looking at. This will be, we're going to go kind of fast through the materials, but the slides are going to be available on the website. So if there's anything that you want to dig back into, don't worry. You'll be able to go back and look at that. And then certainly please reach out to me or anybody on the team for any types of follow-up questions. And we really, as many of you know, we really do look forward to that. So just looking at the housing market, it was really the big story last year was action by the Fed, right? So the Fed ended up cutting rates. That led to a substantial growth in the refi volumes. Total originations finished up at $2.1 trillion, substantial growth over 2018. Freddie's share of that business, the GSE share was a little bit higher than, say the year prior. Freddie's share was a little bit higher. So the volumes you saw coming through the Freddie Mac CRT pipeline grew pretty substantially, and those are still coming through. So as you know, the CRT is on about a 7.5-month lag. So we are still working our way through some of those bigger volumes that came into the second half of the year. That's contributing to some of the really big volumes that we have in 2020. I'll come back to that in a few minutes. I think the other thing, too, is, frankly, since folks talked about spreads, that was really the Fed's activities were a big contributor to the tightening of the spreads in the CRT space. Not only just in CRT, we saw that in the broader fixed income markets. We saw high yields really move a lot more than CRT, particularly towards the end of the year. But CRT did follow a steady grinding in. It finished, strong all the way through December, and through January. The beginning of the January, it's continuing to be on that pace. I think the combination of those macro events and then very specific to the U.S. consumer, the U.S. residential mortgages risk, that has been performing really well. So even as we've had some blips and some investors, kind of generally speaking, moving from a flight to quality, I think the CRT space has filled a lot of that given the confidence in the underwriting and the performance, as well as the broader economy. Clearly, this is, we're selling, below investment grade bonds. So, this is nowhere near the certainty of a treasury security. But I think still the confidence in the overall sector has definitely contributed, as investors and reinsurers have been looking for yields. Moving forward, looking at the, home prices. Home prices, very, very robust. We've had the dip post-crisis in 2012. We've seen steady growth. The rate of home price growth has slowed down. And I've talked to many of you about that, and that's frankly, we're comfortable with that concept. We don't need mid-single-digit home price growth to have a robust housing market. And what we're forecasting, I think we get to it a little bit later, but the 2 to 3% HPA growth as we come into next year. But home prices are certainly the single biggest macroeconomic metric that you can track that directly relates to CRT performance. Certainly, again, with the Fed cutting rates and the deleveraging, interest rates are really important, unemployment, all the other macro factors. But, for a singular metric, home prices are definitely a good factor. Of course, what we're most interested in from a credit perspective is how does that translate into losses. And the first step in losses are, borrowers falling behind on their payments and going delinquent. We've seen that steady trend, the chart on the right-hand side, of losses declining, since the crisis highs. It does seem that the rate of decline is starting to flatten out. So, we're now in that low 60s SDQ rate. I'm not saying that that's going to be the bottom. The rate of decline is just really, kind of slowed. And that's very positive for the market. I think, probably another big, when we look back in 2019, some of the other shifts that occurred with the market is there was probably a higher percentage chance of a recession. And then, as the Fed made its moves and other factors, the likelihood of that recession in many investors' minds really did get pushed back, to whatever that next horizon is. It always seems like it's on that 20 to 24-month horizon when I talk to a lot of investors. But it's important, not only have we looked at, recent performance post-crisis, I think this is some good data going back all the way to the 70s to look at other recessions, just to see how housing has performed during those recessions. So those gray bars that you're looking at are the recessionary periods. The blue line is the SDQ rate, and the black line is home prices. So we've seen, from a long-term trend, our SDQ rate of, low 60s currently, that's a little bit high relative to, historical averages. You can see some places where it's been a little higher, been a little lower. Certainly home prices have been positive, and, we haven't seen, going back into the Depression, we haven't seen home price declines like we saw in the Great Recession. But, for sure, we're subject to business cycles, and at some point recessions will come, and we don't know what that next recession would be. But I think it is helpful to look back at least at some historical performance to see how SDQs have performed under some past, recessions, or instead of solely just looking at the Great Recession. I think this is particularly important as more and more investors are participating lower in the stack, which is definitely a trend that we've seen, is we have more investors in the B1 classes, and particularly the B2 classes. And in those classes, the risk of a recession is certainly a bigger driver in your economic analysis than it is on the, when you're participating in the M1 or the M2 bond. I think another important point, when we look at the macro effects of CRT, again, CRT is designed to be a highly diversified U.S. housing-based single-family residential mortgage exposure. We do issue CRT out of our multifamily business as well. We're here talking about single-family. A big driver behind a lot of country economics are the underlying demographics. And the underlying demographics for the United States are in a really, really good position. Some of the best globally. There are several countries that are experiencing shrinking populations and the issues that those bring. We very fortunately here in the U.S. do not have that. We actually have a very massive cohort coming up in our millennial generation. They are even larger than baby boomers from a count perspective. Gen Z, which is the group behind them, and we actually put it onto the chart what Gen Z is versus a millennial, because everybody always asks, am I a Gen X or what am I? Anyways, but Gen Z is actually also looking to be a very, very large population. So these people will turn into household formations, which will turn into demand for units and homes. And that's going to continue to foster long-term demand for U.S. resi. Now, there's been a lot of discussions of, are the occupancy habits of the millennial generations different than previous generations? We do see the median age of a first-time home buyer is 31, which is right in the middle of that millennial generation from an age distribution, but it's right in front of really the biggest population of that millennial generation as they're coming through. And I think you can run some math and say, even if the millennial generation ends up purchasing homes at a lower rate than, say, some previous generations, just their sheer size of their population is going to lead to really very significant demand. And then I think just anecdotally, and we don't have the data on the screen, but when I see a lot of the studies of the millennials and back post financial crisis, immediately post financial crisis, they were really showing the millennials don't want to go into the home, they want to do something different. Recent studies are showing something a change, kind of more of giving more traditional responses where they do have that. And I would just say the last thing before we leave this slide, there will be, I think, some turnover, when you look at it from a macro perspective, just as that baby boomer generation, does eventually move out of their properties, their dwellings. The baby boomers are holding on to properties at a higher rate, and that's contributing to the supply-demand dynamic. Those properties will start to get freed up, which I think from a supply perspective is good. And again, a slower pace of home price appreciation we think is actually a healthy thing overall for the markets and for the economy, and certainly factors that can contribute to bringing more supply, particularly more affordable supply, we think is also very healthy for U.S. residential and for CRT markets. So Sonya, I was going to talk about the forecast, and then we'll move out of the home price, the macro view. So we do think low rates are going to continue. We have a very solid labor market. We expect home price sales to reach 6 million. We have revised down our mortgage rate from, where we were recently. We're now down. We're projecting from the 3.5 to 3.75. That's down. We were projecting at 3.8, just a couple months ago. We do think the surge of refis are going to continue, but it's going to slow down relative to 2019. However, we're going to have a lot of purchase monies coming in. So, in aggregate, we're projecting new originations to be up to 1.3 trillion, up from 1.26 trillion in 2019. And again, like I said a few times, we're projecting the rate of home price appreciation to continue to decelerate. So from 3.2% in 2019 down to 2.8% in 2020.
Mike, that was helpful in understanding the U.S. housing market landscape. How about you take us through how Freddie Mac CRT has evolved since inception?
So when we look at CRT and, total issuance on the Freddie side of, 50 billion plus, and then, we have several other issuers in the marketplace also issuing CRT at this point, the asset class is really only 7 years old. And I'm taking some liberties with describing the CRT asset class as what Freddie and Fannie started in 2013. Certainly, there are other credit risk transfer trades. Freddie Mac did a moderns trade back in 1998, a synthetic, and we've seen credit derivatives. We see a pretty active reg cap trade in the European markets. But I think it's pretty fair to say the CRT asset class, stands on its own, related to U.S. residential, really started in 2013. Started about a year before, with research. As you mentioned at the top of the meeting, and we've told several folks, I joined Freddie in 2012 to help launch what was then STACR, was the first CRT transaction. But 7 years really isn't very old, just when you think of an asset class of this size and magnitude and economics at stake. If you look at the MBS market, which obviously is much, much, much larger, but it's also decades and decades older. So I think it's very reasonable for the asset class to evolve, both as we get more sophisticated as issuers, as well as our reinsurers and insurers and capital markets investors are all kind of feeding back into the process. Rating agencies are certainly evolving methodologies. So I think it's a really good cycle. I think the pace of change has slowed, but I think there's probably still more to come, and we can touch on that a little bit. But, just looking back very quickly, and I think many of you on the phone have, this cold, but, when we first launched CRT, we made it just a fixed severity transaction, so investors only had to model delinquencies. And then in 2015, we migrated to an actual severity, the actual loss, and we added the A's to our series names, so we had DNA and HQA. That's the standard way, that's the standard approach for transferring credit risk, very similar to PLS market. PLS has a component of credit risk transfer in it as well. In 2018, we did our strategy shift, and we moved away from the early transactions, which only had a 10-year or a 12-year legal final. We expanded that all the way out to the 30-year legal final, and we moved our first loss position down to 10 basis points. So we still have substantial skin in the game. It's a conversation I have occasionally with some investors, particularly some new investors or reinsurers. They say, how do we know, Freddie Mac, that you have skin in the game? Well, we hold on to the first 10 basis points. We always hold on to 5% of the vertical. And you take that risk and you multiply it by a $2 trillion book, and the dollar exposure is very, very, very significant. So we made that shift in 2018, and 2019 was really the first year where we had a full calendar year of that stable structure. And what we saw throughout the year is an increased demand, particularly on the B2s and the B1s. Now, that was largely supported by the macroeconomic conditions that we've gone over, in my opinion. But I think also a contributing factor is just as investors got more and more comfortable analyzing, understanding the risk. One other great development is the number of service providers who are providing analytical services on behalf, for sale or in various management agreements. So the ability for CRT investors to understand the risk has substantially grown over time. We did also introduce REMIC. We long telegraphed on the STACR side that we'd be moving to the REMIC transaction, and we moved to that into 2019. And as we look forward to 2020, it really is towards exiting conservatorship. And FHFA Director Calabria has made it a top mission for FHFA and us. We're in conservatorship. For us to be looking at ways to be exiting conservatorship. And, there's a number of milestones that will be laid out on that path, and it's our responsibility to execute those in a safe and sound manner, while still keeping to the core of our mission, providing liquidity to the marketplace. For CRT specifically, it's very much, maintaining a vibrant risk transfer mechanism, which we will do. I think the potential changes as we look into 2020 is there may certainly the FHFA has gone on record saying that they're looking at the capital rule that's outstanding, the conservator capital framework, or we call it CCF. We could expect some updates to that CCF here in 2020. I'd expect us to look at that CCF and potentially, depending upon, those updated rules, they're typically going to follow a comment period. But, at some point, to the extent that there are updated rules, that may impact, how we do CRT. It could impact, our detachment point. Perhaps our detachment points would be higher or lower. It could impact the amount of CRT that we issue, maybe other LTVs could be covered or not. We may have the same. My guess, and it really is a guess, I'm trying, is I do think that the core of the program is going to be pretty steady. I think this 30-year structure, 10 basis point attachment is really appropriate given our status of being in conservatorship. Again, we don't know exactly what post-conservatorship or what the rules are with exiting conservatorship, but our CRT structure today is well aligned with what FHFA and Director Calabria is asking us to do in terms of transferring a substantial portion of risk to private markets. So with that, just a quick recap of the where have we been. Again, it's been 7 years since the first transaction. $53 billion of private capital has been raised. Very vibrant secondary market, $2 billion of secondary trading for the security transactions. We've had over 245 unique investors participate in the primary sale. So it's been a really robust and successful program. I think we throw around a lot of acronyms. So STACR, just to ground some folks, and to the extent folks haven't really been too close to the transactions they're looking at for the first time. STACR is our capital markets execution. ACIS is our reinsurance execution. The vast majority of our transactions are tied together. When we bring out a transaction, which we group quarterly, when we bring that out onto the STACR side, we're also at the same time bringing it out to the reinsurance side. Our DNA is our low LTV program. It's our 60 to 80s, our HQA, or our 80s to 97s. We have started to issue off-the-run transactions. We started with HARP in 2017, and then we've added the FTR, which just stands for off the run. We've issued that throughout 2019. We have plans to issue that in 2020. So pending market conditions. If the demand is there, we'll look for ways to further accelerate the de-risking of our $2 trillion portfolio by looking at, off-the-run transactions, or to the extent that, hard collateral that it previously wasn't meeting, delinquency tests or whatnot in prior transactions. If there's sufficient collateral in that space to come back out, we could do that. And we're doing the same thing on the ACIS side. I will say each offering, although largely the same, they do have, there are a few key nuances from our perspective. One, the 30-year term is only available in the STACR execution. The ACIS execution is limited to the 12.5-year term. But we also have on the ACIS execution is we have a forward trade. So we currently don't have a forward trade in the STACR capital markets execution, but we do have that ACIS forward in the CRT space. Okay, I'm going to try to do a clarity demo, and we'll see how this goes. So we have some slides in the book, and very similar to how we've done with, our marketing presentations. We've tried to pick the slides that we think are most interesting to you. I wanted to take just 2 minutes to say we're also pushing all this data onto our Clarity portal, which you can find pretty quickly at clarity.freddiemac.com. You can go to crt.freddiemac.com for the broader CRT page. And so to the extent that you're looking for certain collateral cuts or views and we're not giving it to you in the paper form, we want you to be able to go straight to the Clarity platform and be able to pull those directly. This is the Clarity landing page. It's organized with summary data on the front page. We can see aggregate issuance by UPB, STACR ACIS, reference pool deal size. I think there are some specifics when you come to STACR versus ACIS, although frankly the data is largely the same. We have it designed so we have all the way, every transaction back from the early years in 2013 all the way to the current. You can come in, you can filter by, if you're only interested in, say, low LTVs, you're able to come in there and pick low LTVs. I think one, trend, generally speaking, we've seen a collateral improvement throughout the second half of 2019. We made some underwriting changes in 2019, including a push to have all of our loans underwritten through our LPA engine or our LPA tools. We're still in process of that, but the percentage of loans that are running through our LPA tools are way up compared to where we were in the beginning of the year. And so we're starting to see some of those tails come down. Also contributing is we have more refinances, which generally comes with better risk attributes. We've seen some questions about ACE. ACEs absolutely are growing in penetration, and you can see that when you're looking at the data by looking at this ACE column. Recent transactions, we have growth in our 20 DNA1 transaction up to 11%, which is right in line with where we want to go. We're very confident with how ACE is used in lieu of an appraisal. The credit characteristics of the ACE population tends to be equal or better than the non-ACE population. You're able, if you wanted to, only look at ACE, you can come in and you can filter the ACE population only, or the non-ACE population, for example. We can come in and we can look at some benchmarks. So if you wanted to, compare all 2019 transactions with the 2020, I should get rid of the ACE. You're pretty easily able to pick up on that and the credit characteristics, and you're starting to see some of the risk layering start to come down, and that's a trend that we can continue to see. I think the last thing, again, we just encourage folks, if you're looking for more data, to come around and play in here. This is certainly, a chart that gets a lot of use and attention, and it's, when we look at loans with similar FICO scores and LTVs, and we map them back in the historical data set, how has their aggregate performance been? And so we can see, for 2020, losses realized to date for the 2007 book are 3.9% for loans with similar characteristics. And you can very easily switch that, from any transaction, the high LTV HQAs in the marketplace right now. And like I said, all the transactions, back to 2013 are loaded up into the system. So if any folks have questions on how to use the tools, we're happy to do that. I think, we'll jump back to the slides and just talk more about, collateral and performance. So this is, actually, this is pretty much what I just showed in the, so we can go, here we go, perfect. So the slide I showed earlier was macro delinquency trends. I think it's really important to look at them, at a more refined basis. This is a chart many of you have seen previously. On the left-hand side, it's the pre-crisis vintages. On the right-hand side, it's the post-crisis vintages. And if you look closely on the left-hand side, you're going to see that the red line is 2002. It's one of the bottommost delinquencies, ever D90 delinquency lines. When we rescale down the right, 2002, still the red line, but it's at the top. So I think that's really important as we look at post-crisis delinquency performance. And many folks have heard me say this before. The 2012 performance, that was really the best year, and it's likely to be one of the best years for a while. We can see how 2020 plays out with some of the backdrop, macroeconomic and collateral underwriting that we've discussed. But largely speaking, all of the books post-2012 have had slightly worse delinquency curves. And, we're seeing that even with 2018. 2018 is kind of that darker blue line, and hopefully you can zoom in and see that. But keep in mind from a historical perspective where that is relative to, say, like a 2002. And again, we've put out a massive amount of data. If folks think the 2002 isn't the right benchmark because of prepay speeds or whatnot, then, please, you have access. We have data going all the way back to 1999. You can pick other attributes. You can filter it in various ways to try to be able to, get at what you think the right cohorts are. Like we've looked at previously, the losses for 2002 were well below most of the tranches that we're selling. But actual performance, if we move forward a slide, for actual loss transactions, 2015 was our oldest book. We're inside a basis point. Well inside our current detachment of 10 basis points. HQA, our high LTV, has lower losses. Maybe folks not looking at it very closely, they might be surprised at that, but that's really the function of mortgage insurance. So the higher LTVs do tend to default at a higher rate, but their loss given default tends to be lower given the mortgage insurance. And then, we have backstops in place from an issuer perspective related to any counterparty risk associated with mortgage insurance, which certainly is diminishing post-crisis as the mortgage insurers have, raised their capital, as well as they've been very engaged in CRT activities, and they've been de-risking. So overall, delinquencies are low, losses are low. It's been a very benign environment, so this probably really shouldn't be much of a surprise to investors given how well home prices and macroeconomic conditions have been. I think moving forward, one result, and there's no guarantee of this result, but certainly what we've been seeing is because of the strong performance and the deleveraging of the structures, we've seen a lot of rating agency upgrades, and that's been a big win, particularly for the capital markets investors. So the way to read this chart is when we, at issuance, for our front-end cash flows, our M1 bonds, we've issued 48% of the loans, 28% of the loans that when we issued was an investment grade bond is now at a high investment grade, which we call an A-. So you've seen that migration of 28% went from IG to a high IG. And probably more significantly, when you look at the last cash flows, the M2s or our old M3 structure, we had, the vast majority were never issued at even investment grade, and 40% of those are still below investment grade. But now 35% are getting an investment grade, and 23% are getting a high investment grade. So that's really made a very positive impact on the secondary market, for folks that are active in that space. And it's certainly something that we work with the rating agencies. We think the rating agencies have done a great job reviewing their methodologies and training their models to be tying to the CRT collateral and underwriting standards. So I think that just feeds into liquidity a little bit. We're very, very focused on having a liquidity option for the STACR execution. This type of construct doesn't exist in the same degree, and at a very, very small scale it does on the reinsurance markets. But it's definitely an advantage that that we have and we're promoting for the capital markets execution. Investors are able to come in, invest with confidence, knowing that if they want to move out of a position, that they have some markets to come into. Of course, there's always the question, well, will the market, what if the market sees up or look, and hey, I think that's a fair concern, and investors should always give some amount of consideration to that. Markets may not always be so liquid, but I would suggest to you that although generally speaking times have been very good throughout the program's history, we have had a couple of rough spots, including the beginning of last year, and you can observe liquidity. You can observe activity, you can observe dealer support. There have been several large liquidations of investors who had CRT positions, and they had to move large CRT positions, and I would argue that those went fairly orderly. We've seen more support from dealers today than we were a year ago. We've had some new entrants come into the space and putting more balance sheet to both trading as well as repo activities, financing activities for those of you who use financing. So it continues to be a focus for us when we work with our broker dealers. We lay clear the expectation of supporting secondary markets, and that will continue to be a focus for us as we move forward.
Great. Those are great program results. I'm looking forward to hearing what you have planned for 2020. What can you share with us?
So I gave a little bit of a heads up. Just really, big volumes are expected for this year. So we are estimating that we're in the 12 to 16 billion range for total issuance by the time we get to the end of 2020. That's up from 9 to 10 last year in 2019. And there's really two big factors contributing to that. One is the refi wave. So like we said, we're on a little bit of a lag, and those refis are still coming in through our CRT pipeline, as well as we still expect aggregate originations to be up a little bit compared to 2019. Secondly, we're looking to reduce that lag. So right now it takes us about 7.5 months for our benchmark transactions from when we go long the credit risk through the MBS guarantee to when we execute the CRT. We're looking to shrink that window, and we basically want to get it down by at least a quarter. So we're going to print 5 quarters worth of business into 1 calendar year. So those are the drivers that are coming into our 2020 issuance plan. I think folks have already seen that we've had a very busy January where we've issued, both in the reinsurance markets and the capital markets, back-to-back deals with the DNA and now HQA. We're still planning on getting DNA2 out the door this quarter, and HQA2, I think, is very likely to come out this quarter. If not, I think it'll be early in Q2. So that's the biggest driver. Now, again, market demand is very robust right now, but we'll keep tabs on that. We'll look for opportunities to bring off-the-run trades. Like I said, to the extent that there's any more HARP collateral that can kind of meet criteria that's acceptable for investors, I think we can pull that out. We could continue to look at selling previously retained B positions through our FDR trade. That was a pretty innovative trade that I think that we did in December, where we combined it was 8 transactions into 2 deals. There's 4 transactions per deal. It was 500,000 reference obligations, but it brought a basket of goods that allowed investors, to kind of get access to a meaningful piece of that B2 tranche. So I think we'll continue to look at those, and if we have opportunities to bring that in the window, we'll do that. But our main focus is on our benchmark DNA HQA transactions. And in the reinsurance space, we've had success issuing 15-year product. It tends to be a little bit smaller in size, so it doesn't quite make sense to split it up across both. So we'll most likely execute that only in the reinsurance space, but we'll make that determination later in the year. We touched on exiting conservatorship. I think the important thing for investors to hear, and I'm going to try to wrap it up just to see if what questions came in, and we can try to answer them in the last few minutes. I think the important takeaway is folks can expect us to continue to be programmatic issuers in the CRT space. That's completely aligned with our CRT objectives and requirements laid out by FHFA, supported by our senior management here at Freddie. We will be studying CRT, and if there are changes or enhancements that need to be made to CRT, those would all be well publicized. For sure, a change that investors of STACR should be accounting on is a transition away from LIBOR. And even more than a transition away from LIBOR is a transition towards SOFR. So we're working very closely with the industry to try to, make sure that the CRT space is as aligned, in the transition towards SOFR, across Freddie, across the industry. So that's a little bit of a dance. Like we want to be with the market, but at the same time we're a market leader, so we have to be taking positions, to help try to drive that outcome. So, investors in the capital market space can be expecting us to reaching out to them, asking, for their readiness to transition to LIBOR, what it is that they need to get, start consuming SOFR-based new issuance. And then you can count on us to, start to lay out our plans. We want to be very open with sufficient notice for the markets to say, here's what we're looking at doing and when, and to try to really signal that. Again, I think it's more than just moving away from LIBOR. It's moving towards SOFR. And I think some folks maybe are still questioning if SOFR is the answer for the institutional product, and I think that's fair. Again, we're generally moving in that direction. Sonya, whatever the right way to say it.
No coincidence.
That certainly is being used in some instances overseas, but the direction that in our participation with the ARC committee is really moving towards the SOFR, and we'll be in constant touch with the market in terms of getting feedback from them on what we need to make that transition, and then however that kind of comes together, we'd be looking to really lay that out.
Okay, great. But just before we move on to Q&A, I would like to mention that in addition to Mike and myself, Krisha Valencia and Charlotte Gladwin on the security side and Jeff Shu on the reinsurance side are available to answer any questions we don't get to today. You can also find helpful resources and deal-related documents on crt.freddiemac.com and Clarity.
All right, Sonya, thank you. Let's go ahead and see if we have any questions. And as I'm waiting in the queue, if we want to go over the engagement opportunities as well.
Sure. We have a busy first half of the year with engagement opportunities, the very next one being SFIG 2020. We'll have teams out there, so if you would like to meet with primarily the STACR team, please reach out and we could set up a meeting with you guys. The second one would be in New York, IMN CRT Symposium. Again, please feel free to reach out to us. We'll have both the reinsurance teams and the securitization teams there. And last but not least, our favorite single-family investor day for Freddie Mac CRT, June 11th on our campus. We will save the dates out later this week. Please come. You know, we have an informative lineup for you guys, and feel free to reach out to me if you have any questions. So I have the first question.
It says,
okay.
Are there any plans for a possible buyback program? I think that's referring to STACR, although technically you could, you could buy back our ACIS. I haven't really thought about that piece. I'd say no, there are no concrete plans to do buybacks. I think it is a natural progression as an issuer to be, issuing credit protection and then retiring credit protection potentially before the final or the call option. That's something that we would need to take up with FHFA, and we have not done that. But that's something that we would, need to discuss with them in terms of how that would work. So I think it's probably at some point in just a CRT future, I could see that as a normal activity. I don't see anything like that happening in the near term. I think, related to that is it possible for us to do a forward sale of STACR, forward sale of CRTs through the STACR programs? Again, I also think that's a very natural development to have, some type of ability to further hedge our pipeline risk. As again, when, our position as guaranteeing over $2 trillion in assets, pipeline exposure is very massive to us. Perhaps other institutions who don't have such a large book of business, might not be as sensitive to that. So, I think we'll continue to look for ways to try to manage that risk appropriately. We have had great success in the reinsurance markets with our forward trade. So I would think that for 2020, that's going to be the space that we look to do that. But that's not to say that, we can't keep on looking for ways to kind of find that opportunity. It's just, there's nothing in the near-term horizon that we're planning on.
So another question is, given the strong demand for housing credit, why not consider a zero-bid C structure also? You are already retaining a vertical slice.
Yeah, I think that's a great question. We have to keep skin in the game. The 5% vertical slice is, a industry standard from a Dodd-Frank perspective. I think it is important, given our credit risk management role, for us to have that first loss exposure. You could argue is 10 basis points the right, should it be 5 basis points or 0 to the question, should it be 20? I think one of the big reasons we like 10 is because in most years you can expect a 10 basis point loss. Not always. There's certainly going to be some years. 2012 might. We have a number of vintages that are trending that way. They won't even pierce the 10 basis point loss. So I think, given the way we're managing the underwriting and the loss mitigation and the servicing, I think it's really good for us to be having that fulsome position. So there's no plans we would to move off of that. But that's not to say maybe at some point in time, we would look at it that. But we're very comfortable with that structure. That's a structure that we've talked about with our board of directors, and no plans to change. Just given current performance.
Great. So next question, is Freddie considering an early call similar to CAS, which is 7 years?
Yeah, I think that's a great question. we're not considering any structural changes at this point. We made the big strategy shift in the second half of 2018. We ran all of 2019 with that, 30-year term, 10-year call, 10 basis point attachment. I think what we should do is when FHFA issues the new capital rules, we should study them. We may study them and find that there, no changes are warranted to the CRT structure based upon those rules, or we may find that, some adjustments should be made. I don't think, again, we have to see how that process plays out in terms of comment periods or whatnot, but I don't think it makes sense to make any changes right now until we've been able to do that work or until some of the other exit conservatorship milestones are laid out by FHFA. So right now we're very comfortable. We have strong demand from investors up and down our classes in both reinsurance markets and in capital markets. So I think maintaining that structure is the way to go.
Great. Mike, will there be any updates to the Clarity portal in 2020?
Yes, we have plans, but really what we want to do is we want to do user-driven development. We can get a sense of that just from monitoring activity that occurs on the site, but what we really need is investors and reinsurers to tell us what they're looking for. And, our plan, we want to make summarizing that data as easily as possible. It's a massive, massive data set, and so we're, some folks have varying degrees of sophistication and resources to do that on their own. So we want to just make that tool as helpful as possible. So please tell us what you're looking for.
Great.
I just want to say thank you for taking the time and participating in the CRT space, and look forward to talking to you in person.
Yes, and thank you, Mike.
Thanks, Sonya.
Thank you, guys. Have a wonderful day.